In the long run, I'm certain that this will be an asset worth several $1,000,000 per coin, therefore everyone should be ready to cope with volatility and keep an eye on the big picture. I know you're thinking, I'm paying too much if I buy it at 72 today. But I've got one of the best Madeira stories to share with you. I was informed by someone who was familiar with Max that he used this Max Kaiser when purchasing his initial coins. He felt like he had overpaid for the 50 cents since Trace Meyer, a real original. I got mine for 30 cents stock up while you can. This is cutting-edge technology for saving money. Knowing that your money is safe will allow you to relax and enjoy life to the fullest. Equity Management Associates employs the services of Lawrence Lepard, an experienced supporter of fiscal responsibility and a well-known Bitcoin enthusiast. Formerly oversaw a gold stock portfolio and championed fiscal responsibility. Lepard spent a great deal of time encouraging people to buy gold as a hedge against the inevitable devaluation of fiat currencies. Now that Bitcoin has arrived, though, Lepard's goal has become clearer. He considers the leading cryptocurrency to be a better alternative. A digital gold equivalent that, unlike physical gold, offers strong protection against fiat debasement and a plethora of additional benefits. Lepard recently gave an interview to Natalie Brunell in which he made an extremely bullish price prediction for Bitcoin, indicating that its value will rise into the millions of dollars at some point. The persistent debasement of fiat currency is only one factor contributing to this optimistic view. Growing anxiety that the economy will take a nosedive in 2024 is another. Lepard mentioned that there might have been a typo in ISA in President Biden's projected budget of $7.3 trillion. The purpose of this letter is to request that the Federal Reserve, FDIC, and the Office of the Comptroller of the Currency, among other financial authorities, make specific changes to the supplementary leverage ratio. These events, says Lepard, are crucial signs that the United States debt is about to get worse, perhaps even exceeding CBO estimates in the grand scheme of things. These are the things that many of us have been warning about for years, if not longer, especially in the last several years. Everything that has been building for the past 2 years is finally coming together: the ETF's approval, the record deficits, the lack of spending restraint by Congress, the $1 trillion in new debt added in 100 days, and the multiplier effect on Bitcoin's price. As everyone knows, the price of Bitcoin has been on an unstoppable uptrend, reaching new heights since the ETF was approved. One other thing, which probably didn't get much attention but is a big deal, is, hey, you know what? The Industry Swaps and Dealers Association wrote a letter to the Federal Reserve saying just that. It is our firm belief that you should dispose of this SLR immediately. The reason behind the limit on banks' ability to purchase Treasury debt is that there is a lot of debt to sell and the number of available bonds is gradually decreasing. If you read the fine print, there's a lot of financial math and mathematicians involved. Essentially, it's QE infinite on steroids, or it will allow banks to monetize debt indefinitely and record it on their financial statements, since, well, they can effectively purchase government debt with freshly printed money since it is not considered a reserve. It was a letter, but it's obvious that they follow this procedure. They write a letter outlining their plans, and then in 2020 they announced those plans to the Reserve. They did this in 2020 because they were having trouble paying off their debt at the time. Sold the debt at the same time. In my opinion, that's quite significant. Even though Bitcoin and gold, two solid money assets, are at record highs or near record highs, I still don't think the markets have fully absorbed it. Gold, for example, had been trading within a range of $2,100 to $2,100 in the past few weeks, but it has now decisively broken through that range. In light of the global awakening to the problems that many of us in this field have been pointing out for some time, I believe it's safe to say that the government will likely try to solve the sovereign debt crisis by monetizing it. This brings us full circle to the letter I just referenced. Thus, the current climate is as follows. Personally, I think both of these assets have limitless potential. I predict that they will be higher in a month and even higher in 6 months. Biden is proposing a tax on the wealthy, which is a huge increase to the total budget. I read an article in the Wall Street Journal this morning about how unrealistic Biden's projections are and how the CBO predicts a less than ideal outcome for the next 5 or 10 years, including the elimination of recessions within that time frame and a return to 2 or 3% inflation and interest rates. I don't understand where these people get their ideas. Indeed, we are ensnared in a financial utopia that these individuals have created. Nonetheless, there exist unrestricted marketplaces. Among these, Bitcoins is likely the most unrestricted in terms of no room for manipulation, and guess what? People are starting to catch on, not just Bitcoiners, but everyone is, and they're deciding that if you're going to debase their currency, They might as well buy one that can't be debased beyond the programmatic formula. This is the main reason why the price of Bitcoin has reached fresh all-time highs and is expected to continue rising. So my prediction is that the government will face issues if it keeps running deficits and incurring debt. The government spends more money than it receives in taxes. That's rule number one, basically. As bad as it is, we are aware of it. If they issue bonds to fund it, how exactly do they do it? All right, the bond's interest rate and price are both determined, which is a reflection of the forces at work in the bond market. In the absence of demand, the interest rate must rise in turn. This would cause the government to incur more interest costs, which in turn would cause what an obvious debt spiral, as James Lavender has pointed out, means that the federal government and the Federal Reserve have every reason to strive to maintain manageable interest rates. This is an essential part of their job, as we would soon find ourselves in. We are currently in the forest with a 10-year mortgage, but last fall we were at 5 and experienced the problems that caused. So if we went to 5, 6, 7, or 8 on the 10-year mortgage with higher rates or rates that are comparable throughout shorter time periods, the government's interest expense would skyrocket. It's already at over $1 trillion per year, up from significantly less than that 3 or 4 years ago, and the funding and financial problems the government faces would worsen. As a result, the government and others are trying to find ways to increase demand for those bonds, which would lead to lower interest rates. In order to reduce their funding expenses, they are advocating for interest rates to be lowered. Banks can purchase these bonds, and they frequently do, before quickly selling them or adding them to their balance sheets. However, there are restrictions on what they can leave on their books due to the supplementary leverage ratio (SLR), which is confusing even for experts like me. Because it's complex financial plumbing, no one pays much attention to this mechanism, so it's a bit puzzling how it all works. However, when this letter came out, those of us who were aware of it, what about Fed Guy 12? Those of us who are keeping tabs on Lynn or the financial plumbing, like Joseph Wong or Luke Roman, super sexy if I'm understanding this right, these banks can buy all the bonds they want whenever they want because they can just make the money. If we take a broad view, it resembles QE infinity. Now you're aware that it's a sneaky, covert method right now. The Federal Reserve is under the impression that a change from QT to QE would have a significant inflationary effect, therefore doing so would be counterproductive to their efforts to combat inflation. So long as they can manipulate the banks into doing their bidding by altering the rules they are subject to, I'm all for it. They end up at the same spot. The name isn't QE though. That, I suppose, is the gist of it. The banks and the government work together to keep this plan afloat, which is great for the banks since it allows them to profit, and I have a feeling, and here is where things get tricky, that Lynn is the better person to ask about the differential pricing on. Some of the things that we don't know, because she's an expert in plumbing and money, I had to question her about this. However, it's conceivable that they'll find a way to make banks more money, similar to the reverse repo and other tactics they've utilized. You know that banks won't do anything unless they stand to make a profit. So, we haven't seen that yet, but we will. I mean, I think the way they're going to accomplish this is quite clear. This letter was the cherry on top, and I expect it to be released within the next 2 months.